Hello, everyone. Welcome to today's show. Today's content you must listen to the very end because while everyone is focused on NVIDIA's earnings and wondering whether U.S. stocks can keep climbing, the U.S. suddenly dropped a super heavy bombshell, announced a 50% tariff on certain Indian goods. This is not a simple economic event. It is a major move that could change the global landscape for the next 10 years. You might ask, tariffs are just about collecting some money, right? Wrong. Behind this, it's not just about India's fate. It could also affect the wallets of ordinary Americans and even shake the stability of global supply chains. So today, we want to figure out, why did the U.S. suddenly target India? Will India be strangled because of this? Will American businesses and consumers end up paying the price? Could the global landscape be completely reshaped as a result? Don't worry, we'll break these questions down step by step. All you need to do is one thing: hit subscribe, so you won't miss the deeper analysis later. You know, the past few years, the most watched tech stock has been NVIDIA. That's right, the AI wave has pushed NVIDIA to become the brightest star company in the world. Almost all investors are watching its earnings, thinking whether it can continue to drive U.S. stocks higher. But while global investors are all focused on Silicon Valley, the U.S. government suddenly attacked India, announcing tariffs as high as 50% on some goods. And this is not just talk, it's already officially implemented. Many people might find it strange, haven't. U.S.-India relations been improving, from military cooperation to tech collaboration to supply chain relocation. Over the past few years, the U.S. has almost treated India as a strategic partner. Yet, in this context, suddenly flipping the script and imposing tariffs, what's the logic behind it? Think about it. If you are a multinational company, originally moving your factory from China to India to avoid the U.S.-China trade war, and now the U.S. imposes tariffs on India, aren't you being squeezed from both sides? Doesn't this mean companies have to reconsider their next production base? This tariff event sends at least three signals. For one, Indian companies will be hit. Exported goods immediately become more expensive, reducing competitiveness. Two, U.S. businesses and consumers will also pay. Costs rise. Inflation pressure may rebound. Three, global supply chains become unstable again. Companies may consider shifting to Vietnam, Mexico, or even returning to the U.S. This is why we say this is not just about collecting money, but a major earthquake that could trigger a chain reaction. Why did the U.S. choose this moment to hit India hard? On the surface, it looks like an economic measure, but behind it involves political calculations and strategic games. Let's unpack this layer by layer. If you haven't subscribed yet, remember to do it, and otherwise, later you might not find me. To understand the true motives behind this tariff action, we must look at three levels: economic, political, and international relations. These 3 points are like puzzle pieces, and only when combined can we see the full picture. 1. Economic level. Fiscal pressure plus manufacturing anxiety. Let's start with the economy. As everyone knows, U.S. national debt has now exceeded $34 trillion, and just the interest alone costs trillions per year. In other words, the U.S. government is out of money. Imposed tariff essentially collecting extra taxes from foreign companies and importers. On the surface, it's about protecting American workers. In reality, it's also about filling the fiscal gap. Moreover, the U.S. has been calling for manufacturing to return home in recent years. But in reality, many factories haven't returned. They moved to India, Vietnam, and other low-cost countries. As a result, American workers at home haven't benefited much. Tariffs are a whip in the hands of the U.S. government. By increasing import costs, they force companies to reconsider, continue producing overseas, or build factories in the U.S. Of course, many people might ask, does this really bring factories back? In fact, the effect is limited. But for politicians, this is a gesture that can quickly be seen. 2. Political level. Election year performance next. Let's talk about politics. 2024 is a U.S. election year. Every election season, candidates have to put on a performance for voters. And the most sensitive voter group, workers in manufacturing-heavy states. For them, what matters most is job security. The government can show, I am working hard to protect your jobs. It can win more votes. So imposing tariffs on India is not just an economic measure, but a political move. It sends a signal to American blue-collar workers. We are fighting foreign competition and defending your jobs. From this perspective, tariffs are actually a vote-gaining tool. 3. International relations level. Even partners have conflicts. Finally, let's talk about international relations. Many people think U.S.-India relations are rock solid, but in reality, the two countries' relationship is far from as stable as imagined. So, for example, energy issues. The U.S. and Europe imposed sanctions on Russia, while India took the opportunity to buy large amounts of discounted Russian crude oil and even resell some to other countries for profit. Can the U.S. not be unhappy? For example, market environment. Many U.S. companies investing in India have encountered obstacles, such as complex policies, frequent compliance requirements, and even massive fines. But these problems have accumulated over time, pressuring the U.S. government. There's also a deeper factor. India's economy has grown rapidly in recent years, and its international status is rising. The U.S. naturally wants to court India, but at the same time worries that India might grow too fast and become another difficult to control major power in the future. So we can understand it like this. Economic level, the U.S. wants to fill fiscal gaps and prevent manufacturing from flowing abroad. Political level, this is a protectionist performance for voters. International relations level, the U.S. wants to court India but also prevent its rapid rise. These 3 points together form the real logic behind today's U.S. tariff on India. Impact in Indian Dries B9 Nia Nani 9. The question arises, will India be severely hurt? Which industries will be affected first? In the next section, we will take a closer look at the impact on India's economy. As mentioned earlier, the U.S. 50% tariff directly hits Indian exports. But don't forget, it also impacts U.S. companies significantly. Why does this hurt the U.S. itself? Let's explain the logic. According to the New York Times, currently 2/3 of major U.S. companies have investments or branches in India. These companies cover a wide range of industries: pharmaceuticals, IT services, automotive, retail, high-tech R&D, and more. In other words, India is not just an exporter, it's an indispensable part of U.S. global supply chains. One risk of supply chain disruption. Everyone knows in recent years, the U.S. has emphasized gradually moving some production steps elsewhere. Many companies originally focused on India. Because India has several advantages: large population, cheap labor, good language environment, high English proficiency, a large market with strong consumption potential. For example, Apple has already built large-scale assembly plants in India, aiming to gradually move some production from China. But if the U.S. government imposes high import tariffs, it directly undermines these relocation plans. Take Apple as an example. iPhones exported from India to the U.S., if subject to 50% tariffs, immediately lose price competitiveness. Consumers, either prices rise or product supply tightens. For Apple, original strategic plans are effectively shattered. This is not limited to Apple. Companies like General Motors, Ford, Walmart, IBM, Google all have varying levels of presence in India. If tariffs persist long-term, they will have to recalculate costs and consider shifting production to Vietnam, Mexico, or even back to the U.S. Or do cost pressure ultimately pass to consumers? You might ask, will these companies just take the loss? Of course not. Companies are inherently profit-seeking. The cost pressure caused by high tariffs will ultimately be passed on to product prices for consumers. In other words, ordinary Americans may find clothes more expensive in supermarkets, medicines costlier, and even electronic products priced higher. Although the U.S. has temporarily exempted some key areas, such as pharmaceuticals and electronics, these are only temporary measures. Once policies tighten, inflationary pressures will emerge. Here arises a paradox. The U.S. government says it wants to control inflation, yet implements tariffs that may drive prices up. This is also the reason many economists raise doubts. 3. Company confidence undermined, investment delayed. Another critical point is long-term business confidence. Many multinational companies originally saw India as the next global factory. If the trade environment between the U.S. and India suddenly deteriorates, who will dare to invest heavily? It's like building a house, having spent a lot of money, but suddenly hearing the government might impose taxes at any time, even seize your profits. What would you do? Hesitate, pause. This is the real situation for many U.S. companies. Emergence of alternative options. So do U.S. companies have alternatives? The answer is yes. In recent years, countries like Vietnam, Mexico, Indonesia, and even Poland have become candidates for China's industrial transfer. Especially Mexico, its geographic proximity to the U.S. lowers transportation costs. Plus benefits from the U.S.-Mexico-Canada Agreement, USMCA, making it increasingly attractive. What does this mean? It means India's opportunity to take over China's manufacturing role may be weakened by this tariff. U.S. companies will weigh the risks and may not put all their eggs in the India basket. Impact on U.S. company stock prices and investor sentiment. Let's talk about a detail. Many U.S. company stock prices are closely tied to their global supply chains and overseas markets. If investors expect India's market to become turbulent or anticipate potential retaliatory tariffs, capital markets will react in advance. Stock prices may drop, and investment confidence may decline, a chain reaction, especially for tech giants. They rely on Indian engineering teams for R&D while also hoping to leverage India's consumer market. If both directions are hit, investors will definitely reassess the company's future growth prospects. 6. The U.S. government's dilemma. We can see that U.S. companies are caught in the middle, the hardest hit. On one side, the government wants to pressure India using tariffs to force concessions in energy, agriculture, and other areas. On the other side, corporate interests are damaged, potentially causing reverse economic effects. This puts the U.S. government in a dilemma. If it eases tariffs, it may appear weak in negotiations. If it enforces high tariffs, it may hurt its own people's interests. Summary of high tariff impacts on U.S. companies. 1. Supply chain transfer blocked. 2. STS rise ultimately passed to consumers. 3. Company confidence undermined. Investment hesitates. 4. Alternative markets emerge, weakening India's position. 5. Stock prices and capital markets face pressure. This explains why, although the market may not show major short-term fluctuations, hidden risks have already been planted for the long term. India's countermeasures, turning crisis into opportunity, as we mentioned earlier. The U.S. 50% tariff directly hits Indian export industries, employment, and foreign investment confidence. But will India just sit idly by? The answer is definitely no. As the world's 5th largest economy, India will surely implement a full set of measures to mitigate the impact and perhaps even turn this crisis into an opportunity. 1. Diversifying export markets, putting eggs in more baskets. Although the U.S. is an important market for India, it is by no means the only one. Data shows the U.S. accounts for about 17% of India's exports, but the remaining 80% plus is spread across Europe, the Middle East, Africa, and Southeast Asia. What does this mean? India can accelerate cooperation with these regions to dilute the impact of U.S. tariffs. Middle East, India, and the UAE have already signed a free trade agreement, and cooperation with Saudi Arabia and Qatar in energy and chemical sectors is expanding. Europe, India is negotiating a free trade agreement with the EU. Although the process is not easy, if successful, Indian goods will face lower barriers entering Europe, Southeast Asia, and Africa. These emerging markets are growing rapidly in consumption, sensitive to price, and suitable for Indian textiles, pharmaceuticals, and low-cost electronics. In short, India is likely to adopt an if the East is bright, the West is dark strategy. Since the U.S. market is blocked, grab more emerging markets. 2. Strengthening domestic demand. Shifting exports to domestic sales. India has a population of 1.4 billion, already the largest in the world. For decades, India has emphasized export-driven growth, but the tariff hit forces it to reconsider. Should it rely more on its domestic market? The Indian government may take several measures, provide subsidies for companies to sell some export products domestically. For example, textiles and home appliances originally sold to the U.S. can now be sold to Indian consumers with subsidies and tax reductions. Promote credit expansion so more ordinary households dare to consume. For instance, lowering mortgage rates and easing auto loans to boost domestic demand. strength in rural consumption. Rural population accounts for 65% of India's total population. Increasing infrastructure and subsidy investment in rural areas can release huge domestic consumption potential. In other words, India may turn this external shock into a catalyst for accelerating domestic market reforms. 3. Seeking new strategic partners, balancing U.S. pressure. Faced with U.S. tariff pressure, India has another option: cultivating new strategic partners. For example, Russia. India is already a major buyer of Russian oil and weapons. If U.S.-India relations tense, India may further deepen cooperation with Russia. Middle Eastern countries, especially Saudi Arabia and the UAE, both energy suppliers and important investors. ASEAN and Africa, India may accelerate South-South cooperation, strengthening trade and economic ties with developing countries. Geopolitically, India is unlikely to fully align with a single bloc. It is more likely to adopt a multilateral balancing strategy, signaling to the U.S. that if pressure is too high, India has other options. For using the crisis to promote industrial upgrading, moving beyond low-end dependence. Although tariffs hit in the short term, in the long term, they may push India to accelerate industrial upgrading. Why? Many of India's exports are still concentrated in labor-intensive, low-end industries such as textiles, footwear, and basic chemicals. These are the easiest to replace and the most vulnerable to tariffs. The Indian government may seize this opportunity to develop several strategic industries. Information technology. India already has advantages in software, AI, and outsourcing services, and can further move towards high-end segments. Pharmaceuticals and biotechnology, not just generics, but also original drug development. New energy and manufacturing, electric vehicles, solar panels, and other industries that can satisfy domestic demand and tap emerging markets. In other words, India may leverage this tariff crisis to force itself out of low-cost manufacturing and towards high-end manufacturing. 5. Short-term government response. Fiscal subsidies plus diplomatic negotiation. These long-term measures take time. But in the short term, the Indian government will take firefighting measures. Fiscal subsidies support affected industries like textiles and pharmaceuticals to prevent mass layoffs. Currency devaluation, moderate depreciation of the rupee to maintain export competitiveness in international markets. Diplomatic negotiations. Despite tensions, India will not completely break off ties. Through WTO, G20, and other multilateral platforms, India will continue to negotiate with the U.S. Specifically, India may propose conditions in negotiations, such as concessions in energy or investment in exchange for partial tariff removal. 6. Social stability and political maneuvering. To forget, India is a democracy. Public sentiment puts significant pressure on the government. Declining exports and worker layoffs could spark widespread protests. To avoid social unrest, the Modi government may increase social welfare and expand infrastructure projects to absorb labor and divert public anger. At the same time, Modi may emphasize India's self-reliance, framing this crisis as a nationalist opportunity. Appealing to national pride, public anger can be redirected from the government to external pressures. Summary of India's measures: short-term, fiscal subsidies, monetary policy, diplomatic negotiation. Midterm, expand domestic demand, diversify markets. Long-term, promote industrial upgrading, strengthen strategic autonomy. In other words, while the U.S. has caused trouble for India, may also use this crisis to adjust its economic structure and lay the groundwork for future development. Global impact, ripple effects beyond U.S. and India. The U.S. 50% tariff on India is not just an economic skirmish between the two countries. The shockwaves are spreading globally. Trade wars are like throwing a big stone into a lake. The ripples spread circle by circle, ultimately affecting not only the U.S. and India, but the entire world economic landscape. Let's examine this from several angles. 1. Global supply chain rebalancing. First, the supply chain issue. Over the past few decades, globalization's hallmark has been international division of labor. Raw materials may be extracted in Africa, processed in China, designed in the U.S., assembled in India or Vietnam, then sold worldwide. But now, if a long-term U.S.-India trade friction emerges, it will accelerate supply chain reconfiguration. While U.S. companies may shift orders from India to Vietnam, Mexico, or even Africa, Indian companies will seek new markets, turning exports to Europe, the Middle East, Africa, and Latin America. China, as the world's factory, may temporarily benefit. Many U.S. companies find India unstable, yet still rely on China's mature supply chain. This means the U.S.'s original plan to support India to reduce China dependency might backfire. High tariffs could obstruct de-Chinization, possibly even forcing reliance on China. Again, chain reactions in emerging markets. Action against India sends a strong psychological signal to other emerging markets. If it's India today, could it be us tomorrow? For example, Vietnam, the biggest winner in China's industrial transfer in recent years. If tariffs can be imposed suddenly, will companies dare to invest heavily? Mexico, while geographically advantageous. If U.S. inflation pressure rises, Mexican exports could become sacrifices. African countries, many rely on exporting agricultural and primary mineral products. If India can be suppressed, their situations are even more vulnerable. Such uncertainty reduces emerging markets' trust in the U.S. and encourages them to diversify development. 3. Disruption of international trade system. And at a more macro level, the world trade system. The U.S. claims to promote free trade, but frequent tariff impositions in recent years have damaged its international credibility. The WTO exists to resolve such disputes. The U.S. has long resisted its appellate functions. Now, wielding tariffs against India makes the world question whether the U.S. has abandoned free trade rules altogether. If this trend continues, the future may see more regional trade blocs: U.S., Mexico, Canada, Free Trade Area, North America, EU and partner countries, Europe, RCEP Asia, led by China and ASEAN, India possibly joining Middle East and African trade blocs. This suggests global trade rules may further fragment, forming multiple parallel systems instead of a unified free trade market. 4. Geopolitical. Rebalancing economics and politics are always intertwined. The U.S.-India trade friction may accelerate geopolitical reordering. U.S.-India relations strained. The U.S. originally aimed to use India to contain China. Friction erodes trust, potentially cooling ties in the short term. Sino-Indian relations, subtle shifts, although border tensions exist. Excessive U.S. pressure might lead India to adopt a more neutral stance toward China in multilateral organizations. For Russia's opportunity, Russia has long sought to expand cooperation with India. If U.S. ties sour, Russia can step in. Role of the Middle East. Don't underestimate Middle Eastern countries. They have oil, capital, and global ambitions. If India needs energy or investment support, the Middle East becomes a natural partner. In short, U.S.-India friction is not merely, it may accelerate a multipolar world. 5. Drag on global economic growth. Trade friction eventually reflects in reality. Global growth may be dragged down. For IMF, studies show that a 1% tariff increase slows global GDP growth by about 0.1% to 0.2%. For a large-scale, high tariff like U.S.-India, the impact is more significant. Short-term, global markets may not fluctuate violently, but long-term, friction increases investor caution, slows multinational expansion, and erodes market confidence. The impact is not limited to the U.S. and India. All countries trading with them feel the effects. 6th, perspective of investors and ordinary people from an investor's perspective. U.S.-India friction increases uncertainty. Capital hates uncertainty because it makes forecasting difficult. Result, capital may prefer stable assets like U.S. Treasuries, gold, or Swiss assets. From ordinary people's perspective, the global friction manifests as Americans spending more on daily necessities, Indian workers losing jobs due to declining exports, citizens in other countries affected by global market instability. Overall, the global impact can be summarized in 6 aspects: 1. Supply chain rebalancing, possibly increasing reliance on China. 2. Emerging market confidence shaken, pushing them to diversify. 3. International trade system further fragmented. 4. Geopolitical reordering, accelerates multipolarity. 5. Global growth dragged. 6. Investors and ordinary people bear the cost. In other words, this is not merely a U.S.-India confrontation. It is a game that may reshape the world economy. More long-term lessons for India, although India suffers short-term shocks, right, is forced to confront its long-term reliance on low-end exports. Industrial upgrading, technological innovation, and increasing added value are the paths India must take. Expanding domestic demand and strengthening the internal market reduces external dependency. Multilateral diplomatic strategies allow India to maintain space in the great power game while avoiding over-reliance on a single country. Short-term pain could catalyze India's future economic resilience as long as the government stabilizes employment, maintains social stability, and guides companies toward high-value industries. India has the opportunity to achieve a reverse wind turnaround. For the U.S., this tariff action highlights a reality. High tariffs may serve as negotiation tools, but can harm domestic companies and consumers in the long run. Our global supply chains rely heavily on cooperation. Excessive unilateral pressure may trigger chain reactions. Policymakers must balance short-term political gains with long-term economic costs. In short, pursuing strategic interests requires assessing potential global economic side effects. Otherwise, protectionism may backfire. Global lessons globally. This friction reveals several trends. For multipolar acceleration, countries increasingly diversify trade and diplomacy rather than relying on a single power. Supply chain decentralization. Companies diversify across countries to mitigate risks. But the global supply chain becomes more dispersed and complex. Our policy market interaction intensifies. Trade policies, tariffs, and geopolitical events increasingly affect markets and investor sentiment directly. This reminds investors and ordinary people in today's interconnected global economy. Policy trends and international relations may impact daily life more directly than earnings reports. Looking ahead, the future of U.S.-India relations likely follows stages. 1. Friction stage, short-term export restrictions, tariff pressure, and negotiation stalemates. 2. Adjustment stage, India accelerates export diversification and industrial upgrading. U.S. companies redeploy supply chains. 3. Long-term win-win stage. Both sides find new balance. U.S. firms continue investing in India. India moves toward equality growth. Global supply chains stabilize. Uncertainties remain, such as global economic shifts, other countries' trade policy changes, or sudden geopolitical events. Each change could be a new variable. Takeaways: Ford Fund Chain saying 90 some takeaways. Monitor policy trends. High tariffs and trade friction directly affect product prices, corporate profits, and investment opportunities. Observe industry layout, manufacturing developments in India. Vietnam, Mexico may influence global supply chains and indirectly investment strategies. A focus on long-term trends. Short-term shocks may cause volatility. But industrial upgrading, market diversification, and globalization remain core directions. U.S.-India trade friction is a comprehensive game of economics, politics, and diplomacy. For observing, it helps understand not just the event itself, but the logic behind global economics and investment. Conclusion. Factual for today. If you found this analysis helpful or want to keep following U.S.-India trade friction, for global supply chain trends and international financial developments, click subscribe and turn on the bell. We will continue to provide the latest insights, helping you understand the logic behind international situations. Feel free to comment on what you care about most: India's industrial impact, U.S. company cost pressures, or global economic changes. We will select questions for deep analysis in the next episode. Thank you for joining me today. I hope you gained a lot. See you next time.